In this video, we're going to be focusing on how to calculate tax liability. Now, in front of you, you can see here I have a tax schedule, and this is broken down into 4 different categories. And so you can see from left to right, you have your tax rate, single, married, and head of household. Now, these represent how much we would pay in taxes, these income bands. And so in the United States, we've got a progressive tax system, and that means that as your income increases, so does your tax rate. But contrary to kind of popular opinion, your income is not all entirely taxed at that rate. And so we have these kind of tax bands, if you will. So looking at the top, you can see that we have the tax rate of 10%, and then single, married, and head of household. This is your filing status. And so if you're single, you're typically filing as single. If you are married, you have the option of filing at the married, filing jointly, or of course you can file individually as singles, and then there is the head of household as well. So depending upon your filing status, you'll follow one of these 3 schedules. So looking at this, one of the things I want to mention first is that we're using adjusted gross income to calculate our tax liability. Now that is typically defined as the income that we earn minus specific deductions. And so this will take a little bit of calculation, but obviously is not going to be the same as your kind of gross pay that you receive. There's going to be certain deductions factored out of this. Charitable contributions, those sorts of things will come out first before we get to the AGI, which we'll cover in a separate video. So assuming we have our AGI though, we can actually utilize the income tax schedule to make a determination as to how much taxes we might owe, or our tax liability, as it's often called. Now, this mirrors very closely the U.S. or United States federal tax schedule. For the state level, depending upon whether or not your state actually has or charges income taxes. Many states do, but some do not. There would be a different schedule, so I would encourage you to look through that if you wanted to calculate your state tax liability. So we're going to walk through just a couple of problems here so you can kind of see how to utilize the schedule. So the first thing that we're going to do is we're going to run through a calculation for the head of household. And so I'm going to go ahead and we're going to use a different pen color so we can keep these calculations separate since we don't have a ton of room. And so we'll go ahead and mark the first question here. And for the first question is we're going to try to compute our tax liability, assuming that we're filing as the head of household, which I'm going to abbreviate as HH, with a taxable income of $55,000. So the first thing we're going to do is we're going to go over to the head of household column, which you can see here. And again, you just look all the way across for the tax rate. So I mentioned that the US has a progressive tax system. So what this means is the first amount of money that we earn, up to $14,100, is taxed at the 10% rate. That next income in between $14,101 and $53,700 is taxed at the 12% rate. So that's where we get the progressive tax portion there, is because the additional income outside of this first band is taxed at a completely different rate, and then we add up those individual calculations. So that's contrary to popular opinion, which would say that if we, let's say, earned the $55,000 in income, we would be taxed at the 22% rate, which is not entirely true. Only a small portion of our income is actually going to get taxed at that rate. So for starters, let's go ahead and determine our tax liability. So we're just going to go kind of down the tax schedule, right, through 10%, 12%, and 22%. And then we can add everything together, and that's going to be our approximate tax liability. So the first tax rate is up to $14,100 is taxed at 10%. So just by moving the decimal, we know that that is going to be $1,410 in taxes. So that's the amount of taxes that we would pay on that first $14,100. And we're going to add that to the next column. So here is where you have to do a little bit of a math, so it gets a little tedious, but not too bad. So what we would have to do is we're going to take 53,700, this number here, and then we're going to subtract it from 14,100, and that's going to give us 39,600, right? So the difference between these two is 39,600. And notice I subtracted by the end range of the first column. Ultimately, it's not going to make a huge difference if you choose to subtract 14,100 or 14,101. You're going to get close enough to do what you need to do based upon that figure. So we're going to take this amount here, and then we're going to multiply it by the 12% tax rate. And that, if you do the math real quick, and feel free and do so, pause the video and come back and follow along, that is going to get taxed at 4,000, or our liability is $4,752. So notice, obviously more tax liability from this center column, but this center column really represents a majority of our income for the most part. Now we're going to move on to the last one. So since we earned $55,000 in adjusted gross income, we technically fall into this kind of third bucket here. And so we're going to take our $55,000 in income and we're going to subtract it by the 53,700, and that's going to get us $1,300. So that same thing, that 100,300 multiplied by the 22% rate is going to be an additional $286 in tax liability. So notice that clearly a majority of our tax liability has from that center column. However, if our income was, say, closer to 85,000 here, then that would get taxed at a much higher rate, right? The jump from 12 to 22 really affects what we call our effective tax rate, which is ultimately overall the taxes that you pay as a percentage of your income, and I'll show you how to calculate that. So first off, let's go ahead and add these numbers together. So we've got $286, we've got $4,752, and then $1,410, and that's going to give us a tax liability of $6,448. Pretty straightforward. Now, if we wanted to determine our effective tax rate, so first off, this is our tax liability. So the answer to the question is this: we would pay $6,448. Now, that doesn't mean that that's what we would pay. That's our tax liability. So if you have a salary or draw a salary where you get a W-2 every year, then there's a percentage of your income that you're kind of putting away, right? And that's to offset your tax liability. So depending upon how that works, if you have contributed or had withdrawn, let's say $7,000 over the course of the year towards your federal income taxes, you would actually get a little bit of a rebate because your tax liability is only this $6,448. Now, conversely, if you only had $5,000 put away, well, then you would owe just shy of $1,500 in taxes, right? So you can use this schedule as a way of determining your tax liability, and then you can work backwards and adjust your withholdings and different things to try to get as close as possible, because obviously no one likes to really owe a ton of money at the end of the year, but also getting a huge refund isn't ideal either, because that essentially just represents an interest-free loan to the government, and you can have that during the year and put that to good use. So moving to effective tax rate, let's say we wanted to compute our effective tax rate. What we would do is we would take our tax liability and we divide it by our adjusted gross income, which is $55,000. So if you do that, you should get 0.117, which in a percentage form represents 11%. So although based on our income, we fell into the 22% tax bracket, we effectively are paying 11.7% in taxes. And this is by and large why if you're able to itemize deductions, it becomes particularly helpful, because you're able to reduce your adjusted gross income, and ideally to the point to where you fall into these lower tax brackets, right? Once you start getting into the 20s and the 30s is where it can really add up and pretty quickly. Let's go through another problem just so you can, again, get a little bit more practice. All right, so let's try this again, just so, again, you can get a little bit more practice. So for this one, let's assume that we're a single filer. So we're going to change up the numbers we're looking at. And we're going to assume that we have an income of $35,000, or more specifically, an adjusted gross income of $35,000. So we're going to use the same process to make these calculations, but the difference is going to be the numbers that we're referencing. So the starting point, let's take a look at where $35,000 fits on the schedule. It actually puts us right in here into this second row at the 12% rate. Again, not all of our income is taxed at the 12% rate, just the amount that exceeds that first column there, or that first row, I should say. So let's go ahead and add these up. So we know that up to $9,875, we get taxed at the 10% rate. So we can compute that relatively easily just by moving the decimal, and that is $987.50 that we're taxed at that first rate there. Now the second one is where we have to do a little bit of math, right? Because our adjusted gross income is $35,000. So we're going to take $35,000 and we're going to subtract it from $9,875, and that's going to get us $25,125. That we're going to multiply by 0.12, which is the second tax rate. And that will get us $3,015. Now adding these two together, we're going to get a grand total tax liability of $4,002.50. And if we wanted to calculate our effective tax rate, we would multiply that again by or divide that by our adjusted gross income, and that's going to get us 11.4%. So notice the effective tax rates here are pretty similar, and that's largely because we sort of end up on the same end, right? Although the $55,000 is clearly a lot more than $35,000, the tax bands are a little bit different for heads of household versus single, so that's something to take into consideration. And then we really only fall into that third row of 22% on the head of household for a very slim margin, right? We only had the $286 in tax liability there, which is why they're fairly similar. Let's do one last one. I'm sure you're beginning to kind of get the concept and understand the rhythm of how everything works, but let's do one more. So let's use the last column. Let's assume that we are married and we're going to file a joint return with our spouse. And then we're going to have a tax liability, or adjusted gross income rather, of $72,000. So very similar. Let's take a look at where that ends up on the tax schedule. So that's going to be still in the 12%. And it's going to be roughly right around here, just shy of the $80,000. That would send us into the 22% tax bracket. So we're first going to take 10% of this $19,750. So that's going to be $1,975 in tax liability from that first rate. And then we're going to have to, again, do a little bit of math to figure out how much of our income is going to be taxed at the 12% rate. And so we've got $72,000, and we're going to subtract that from $19,750, which should get you $52,250. That is the amount that we're going to tax, or we're going to multiply by this 12% to see what our tax liability is, and you should get $6,270. Now altogether, that means that if we were married filing a joint return with our spouse and collectively earned an income of $72,000, our approximate tax liability would be $8,245. Now I say approximate because that's dependent, of course, on us actually calculating our adjusted gross income accurately, which is an important first step. But assuming that this was our tax liability, dividing this by our adjusted gross income of $72,000 would give us a very similar effective tax rate of 11.4, really 11.5 if you round up, which I did not. So very similar overall. So if you were to look at the incomes from each of them, you would assume that, well, the 35,000 would be taxed the least, and then 55 and then 72. And that is somewhat correct, because if you look here, the effective tax rates are all pretty similar. The difference, of course, is the actual amounts that each of them earn and the different tax ranges here. So all relatively similar, and that is by design, because really most of them are primarily taxed into those first two rows at the 10 and the 12% rate, with only the head of household kind of getting into that third income band, if you will. So that's how to calculate tax liability. Again, the important things you need to have ahead of time are your adjusted gross income calculated, which you can do so on your own. And then 2, you need access to the federal income tax table. If you're doing this on your own for purposes of adjusting your withholdings and those sorts of things, I would definitely recommend making sure that you have access to the most updated table, because that is the one that the IRS is going to hold you accountable for. All right, hope this was helpful. Thanks for watching, and we'll see you soon.